We now move on from the government sector to the corporate sector. Companies differ from governments and government-related entities in that their primary goal is profit, and that their borrowings tend to be of a much smaller scale. In this lesson, we shall look at some of the ways companies raise capital, through bank debt, through issuing commercial paper, and through issuing corporate bonds. Let's dive right in. Companies routinely raise debt as part of their overall capital structure. The capital raised is to fund both short-term spending needs as well as long-term capital investments. We have so far focused on publicly issued debt, but loans from banks and other financial institutions are also a significant part of the debt raised by companies. Most corporations fund their businesses to some extent with bank loans. Bank loans are the primary source of debt financing for small and medium-sized companies. In countries where bond markets are underdeveloped, large companies also use this source for debt financing. When the loan involves only one bank, it's referred to as a bilateral loan. In contrast, when a loan is funded by several banks, it's referred to as a syndicated loan. The group of banks is known as the syndicate. In addition to banks, a variety of lenders participate in the syndicate, such as pension funds, insurance companies, and hedge funds. In recent years, a secondary market in syndicated loans has developed. These loans are often packaged and securitized, and the securities created are then sold in secondary markets to investors. Most bilateral and syndicated loans are floating rate loans, and the interest rate is based on a reference rate plus a spread. The reference rate is usually LIBOR, or the prime lending rate, also called the prime rate. The prime rate is the overnight rate at which banks lend to each other. Bank loans can be customized to the borrower's needs. They can have different maturities, different frequency of interest payments, and different interest payment and principal repayment structures. Some loans are bullet loans, in which the entire payment of principal occurs at maturity. Others can be amortizing loans, in which the principal is repaid over the loan period. For larger creditworthy corporations, taking a bank loan can be more expensive than if it issues debt to the public. Such corporations can choose to reduce funding costs by issuing short-term unsecured debt securities, referred to as commercial paper. For these firms, the interest cost of commercial paper is less than the interest on a bank loan. Commercial paper is a short-term unsecured debt instrument. Firms use commercial paper to fund working capital and as a temporary source of funds prior to issuing longer-term debt. In the United States, commercial paper is issued in US dollars only, with maturities of 270 days or less. This is because debt securities with maturities of 270 days or less are exempt from SEC registration. Euro commercial paper is issued in several countries and can be denominated in any currency. The maturity can be as long as 364 days. Similar to US T-bills, US commercial paper is typically issued as a pure discount security, making a single payment equal to the face value at maturity. Prices are quoted as a percentage discount from face value. In contrast, ECP interest rates may be quoted as either a discount yield or an interest-bearing yield. To illustrate the difference between the two, let's look at an example. Company A issues a $1 million 180-day US commercial paper. The annualized interest is quoted at 6%. So in this case, the interest is $30,000. Since US CPs are quoted on a discount basis, it's issued to investors at a discounted price of $970,000. The par value of $1 million is returned to investors 180 days later. Company B issues a £1 million 180-day Euro commercial paper on an interest-bearing basis. The annualized interest is also quoted at 6%. So in this case, the interest is £30,000. Since the commercial paper is quoted on an interest-bearing basis, it is issued to investors at the par value of £1 million. The par value plus the £30,000 interest is paid to investors 180 days later. Note that although the quoted annual interest is the same, The holding period yield of the two investments is not the same. Under a discount basis, the holding period yield is 3.09%. The holding period yield on an interest-bearing basis, however, is just 3%. Commercial paper is often reissued or rolled over when it matures. Rollover risk is the risk that a company will not be able to sell new commercial paper to replace maturing paper. This can be due to a deterioration in the company's ability to repay the debt. This can hurt investors' confidence, leading to less than full subscription to a new issue. Another factor could be a significant systemic financial distress, as was experienced in the 2008 financial crisis. Such extreme fear in the market may freeze debt markets so that very little commercial paper can be sold at all. In order to get an acceptable credit rating from the rating services on their commercial paper, corporations maintain backup lines of credit with banks. These are sometimes referred to as liquidity enhancement or backup liquidity lines. The bank agrees to provide the funds when the paper matures if needed, except in the case where the company's financial situation has deteriorated significantly. Another form of public debt that larger companies usually issue is corporate bonds. We shall examine corporate bonds based on the features original maturity, coupon payment structure, principal repayment structure, collateral backing, and contingency provisions. With original maturity. For corporate bonds, there's no universally accepted taxonomy as to what constitutes short, intermediate, and long-term maturities. For our purposes, short-term refers to original maturities of 5 years or less, intermediate term to original maturities longer than 5 years and up to 12 years, and long-term to original maturities longer than 12 years. Securities with maturities between 1 and 12 years are often considered notes, whereas securities with maturities greater than 12 years are considered bonds. It's not uncommon, however, to refer to bonds for all securities, irrespective of their original maturity. Corporations often issue debt securities called medium-term notes. This term, however, is a misnomer. MTNs are not necessarily medium-term in maturity. There are MTNs issued in various maturities ranging from 9 months to periods as long as 100 years. MTNs have the unique characteristic of being securities that are offered continuously to investors by an agent of the issuer. Issuers provide maturity ranges for MTNs they wish to sell and provide yield quotes for those ranges. Investors interested in purchasing the notes make an offer to the issuer's agent, specifying the face value and an exact maturity within one of the ranges offered. The agent then confirms the issuer's willingness to sell those MTNs and effects the transaction. This feature gives the borrower maximum flexibility for issuing securities on a continuous basis. Corporate notes and bonds have a wide range of coupon payment structures. Coupon payments can be made annually, semi-annually, or quarterly. Most corporate bonds pay coupons semi-annually. Financial and non-financial companies issue conventional coupon bonds that pay a fixed coupon during the bond's life. They can also issue floating rate bonds where the coupon payments adjust to changes in a certain specified metric. Such a metric can be the level of market interest, usually referenced by the LIBOR rate. Such bonds limit interest rate risks for the investor. The level of inflation, usually referenced by an inflation index like the Consumer Price Index. Such bonds limit inflation risk for the investor. Or the issuer's credit quality. When the credit quality goes down, investors are compensated by getting a higher coupon. Such bonds limit credit risk for the investor. Besides fixed rate and floating rate notes, issuers have the choice of other coupon payment structures which give them more flexibility regarding the servicing of their debt. Such coupon structures include payment-in-kind coupon bonds, which make periodic coupon payments, but not necessarily in cash. The issuer may pay interest in the form of securities, such as bonds or common shares. Deferred coupon bonds. The issuer pays no coupon initially, but then offers a higher coupon later. And zero coupon bonds, which pay no coupon. Such bonds are sold at a discount to par, so the interest is implicitly priced into the discount. Next, we study the different ways a company can structure the principal repayment structure of a bond. Most bonds are structured such that the full principal amount is repaid in one lump sum at maturity. One issue with bullets is that the balloon payment at maturity is much higher than the periodic interest payments. For bonds with a longer maturity, the bondholder bears a higher level of credit risk. Earlier, we've discussed a sinking fund provision as a way to reduce the credit risk of a bond by redeeming part of the bond's issue periodically over a bond's life. Let's revise this concept again. We use the illustration of a 15-year issue with a face amount of $100 million. Let's say this bond issue has a sinking fund provision that requires the borrower to retire $10 million each year starting from the 6th year. So for the first 5 years, the par value of the outstanding bonds is $100 million, but from the 6th year onwards, the amount of outstanding bonds should be lowered by $10 million each year. There are two ways the borrower can retire the required amount of bonds. It can either redeem the bonds from randomly selected bondholders at par value or buy back the bonds from the open market at the market price. If the market price goes below par, the bond issuer is more likely to buy the bonds from the open market at the market price. This may have the effect of increasing the market price, which will make the bondholders happy. However, the bondholders may not be happy if the reverse happens. If interest rates have fallen since issuance, the market price will likely be higher than par. The bond issue will more likely redeem the bonds from selected bondholders at par value. Imagine if you're the bondholder. You may get very mad because you're only getting back the principal, rather than the higher amount that you can sell it for in the open market. Now, you can see that such an arrangement clearly favours the issuer, as he has the flexibility of choosing the option that favours him based on the market conditions. The bondholder, on the other hand, is disadvantaged because she does not have any certainty regarding the future cash flows. As the bonds are randomly chosen to be redeemed, she doesn't know when exactly the bond that she is holding will be redeemed. An alternative to this is a serial bond issue. With a serial bond issue, bonds are issued with several maturity dates so that a portion of the issue is redeemed periodically. The issuer has to redeem specific bonds at their specific redemption dates. So, as in this case, if the bondholder is holding to a bond with a specified redemption at the beginning of the 9th year, the bondholder can be sure that this will happen. Such a principal repayment structure, where maturity dates are spread out during the bond's life, is known as a serial maturity structure. In contrast, when all the bonds mature on the same date, we call this a term maturity structure. Corporate bonds are often structured with collateral backing to improve the credit quality of the issue. Different issues from the same company can have different seniority ranking. That is, the systematic way in which lenders are repaid in the event of a default. Secured bonds have some form of collateral pledge to ensure payment of the debt. There is a wide range of bonds that are secured by some form of collateral. Companies that need to finance equipment or physical assets like aircraft and railroads may issue equipment trust certificates. Collateral trust bonds are secured by securities, such as common shares, bonds, or other financial assets. In contrast, unsecured debt only have claims to the general assets of the company, after the bondholders that have more senior bonds have been paid. Companies can and do default on their debt. In general, secured bonds should sustain less loss than unsecured bonds. Unsecured bonds therefore have a higher level of credit risk. Investors require a higher yield for unsecured bonds as compensation for the increased credit risk. We shall discuss more on the finer gradations of rankings in a later topic on credit analysis. Contingency provisions are clauses in the indenture that provide the issuer or the bondholder's rights to some action when a specified event occurs. The most common provision for corporate bonds is the call provision. This allows the issuer to redeem the bonds at a predetermined price before maturity, on specified call dates. In contrast, the put provision allows the bondholder to sell the bond back to the issuer at a predetermined price on specified dates before maturity. The convertibility option allows the bondholder to convert the bond into a specified number of shares of the issuer's common shares. We've discussed these three provisions in detail in the lesson on contingency provisions. Do refer back to that lesson, as all three provisions can be applied to corporate bonds. And that concludes this lesson on corporate debt. We shall move on to structured financial instruments in the next lesson.